playing the bangers. Hold up. Hold up. Yeah, we're playing the bangers here. Better than our normal music. Yeah, that hurts. That cuts me right to the core. What's up, boys? This is the Fed's Innovation Payments Conference. So now, 𝐒𝐴 not speaking. So if you're here for 𝐒𝐴, I'm sorry. But he will join us next week, the 29th, for the FOMC, the biggest, the greatest, most important FOMC of your lives. So you better be there. Today they are talking, and they have been talking actually all day. We are late. I'm late. I decided, might as well jump in here. Topics so far have been, let me make sure this is correct. Topics so far have been, I just had this pulled up. How is this even possible? I closed it. Well, either way, not the topics so far. The topics now are AI in payments. The topics earlier didn't seem as good. This one seems solid, seems important, seems like they'll have something to say. Big names are here. BlackRock's here. People are talking about Chainlink. People are here. Cathie Wood's on this panel.
It's very quiet now. We went from a very lively, engaged, and some might even say loud lunch, to this very quiet, moment, I have to say. So I see folks are still trickling in a little bit. But I'm going to introduce our third panel. I'm very excited to have us a group of folks that's going to talk about AI and payments. Our moderator will be Matt Marcus. He's a co-founder and CEO of Modern Treasury, a payment infrastructure company focused on the automation of payment movement. And with that, Matt, I turn it over to you. Take it away.
There's going to be a lot of jargon.
Thank you.
For sure.
We have the coveted after lunch spot, so everyone stick with us.
That's the best spot, brother.
I just want to thank the Fed for hosting us this week, Governor Waller, thank you. And also we've gotten to work with a lot of the Fed team over the years, and so we've always been very impressed with everyone we get to work with, and just sharing the mission around advancing money movement in the country has been really exciting for us to work on. So thank you all for supporting that with the infrastructure you provide.
He means us.
I'm the co-founder and CEO of Modern Treasury. We're a payments infrastructure company that works with fintechs, startups, public companies to help them automate money movement. And so we work with companies that provide critical infrastructure to the economy across all different sectors: real estate, healthcare, education, payroll, so forth. So I'm excited to get us together to talk about AI and payments. And so we have a great panel here today. I'm going to let everyone introduce themselves in a second, but we'll try to cover a few different areas because, what does AI and payments mean to you is something we'll cover different areas. We'll talk about agentic commerce a bit. That's a big theme of the day, so we want to make sure to get in there. We'll talk about fraud, which is always top of mind, especially with AI. So want to make sure we talk about how companies are thinking about that, how you can think about that. AI also impacts our internal processes. So how do we fight fraud? How do we build software? How do we advance payments innovation? And so assuming we have time, we'll get there as well. So that way we can think about how are we pushing the ball forward on innovation in the country. So with that, we'll kick things over for intros from the panel. We can just go in order here.
Yeah, kick it over. Cathie Wood. 𝐴𝐴, big name.
The red light means on.
Okay. Hi, my name is Cathie Wood. I am founder and chief investment officer of 𝐼𝐭 We manage roughly $40 billion in equity assets focused exclusively on technologically enabled disruptive innovation. So the 5 major platforms are robotics, energy storage, AI, blockchain technology, and multi-omic sequencing. And our focus today especially is the convergence among those technologies. And I know that's one reason we're here. So very happy to be here. And I must say, I want to give a shout out, first of all, to Governor Waller and to Sunaina. About a year ago, I'm going to say, I found out, she approached me, I think, that you had a director of research on innovation, and I thought, wow, now we're talking. I hadn't associated the Fed with innovation, but I see how much you all are doing. You all are doing now, and she has been a force, to be sure, working with you, Governor Waller.
Yes, thank you. Thank you. I'm
I
grabbing her
love that
wallet.
intro. I agree. She has been a force.
Yes, yes,
Alicia
quite a
Haas. I'm the Chief Financial Officer of Coinbase. Coinbase
I
is
didn't know that.
one of the
CFO
first
of
and
Coinbase.
definitely the largest in the U.S. crypto infrastructure companies, and a company that offers the ability to buy, store, transact in over 300 crypto assets on our platform, and then increasingly building on-chain. We have co-founded USDC, which is the second largest global regulated stablecoin with Circle, and are the largest distributor of stablecoins in the US market and globally, including USDC, �PYUSD, and others. And importantly, are continuing to build tools for developers for them to build their own crypto solutions, their own payment solutions, and excited to be here for this conversation.
I'm excited to have you here.
I'm Emily Sands. I'm the head of data and AI at Stripe. Thank you so much for having us today.
We're coming
Stripe
down.
builds programmable
Stripe's still
financial
cool.
infrastructure. So we support millions of businesses around the globe in accepting payments,
Check.
moving money, and growing efficiently. Those millions of businesses include many SMBs, startups, including most of the AI startups, and also very large enterprises, including about half of the Fortune 100.
Hi, everyone. Thanks for having me. My name is Rich Widman. I run Google Cloud's global crypto strategy. Our team is really responsible for doing basically three simple things, not to understate it. The first is our main charge is to think about how large enterprises like Google incorporate some of these new technologies, not just in terms of our products, but also into our own kind of financial infrastructure, our own financial or enterprise DNA. The second thing that we're responsible for is we recently launched a layer 1 blockchain called the Universal Ledger, which is built for institutional payments, which has dominated much of the discussion today. And then lastly, we're also responsible for working on large open standards related to agentic payments, most recently the Agentic Payments Protocol, or AP2, which we partnered with Coinbase and about 100 others on in terms of thinking about what agentic commerce will look like, what forms of payment will agents use, and how do we complete that trust chain so that users and merchants can transact with AI confidently.
Great.
Perfect
Well,
line
Emily, we'll
from
start with you.
yesterday on Zach.
Agentic commerce, we've heard about that a bit. What is it?
Good question. I have no idea.
So, we're all experiencing how AI is shifting, especially over the last year or so, from just knowing, giving you the answer, to doing, executing on your behalf. And that shift from knowing to doing is quite profound, and one of the first industries that it's transforming is commerce, how commerce gets done. Agentic commerce is actually a spectrum, but I think of it as an agent facilitating a transaction between a buyer, whether a consumer or a business, and a seller. And if you think about a very simple but powerful consumer experience like instant checkout in ChatGPT, you can go today and look for a Halloween costume and get recommended costumes from millions of merchants. Maybe they're not all selling costumes, but certainly millions of merchants selling on Etsy, and you can buy direct in one click. And that feels slightly more deterministic than maybe the pie in the sky version of agentic. But along the spectrum, you see things like Perplexity travel search and booking agent, where I can say I want to go to Paris, these are my dates, here's my budget, and it finds the flights and finds the hotel and gets the reservations for me on my behalf in a cohesive package. And so, Stripe has worked with businesses for over a decade, helping them sell wherever customers are. And early days for us, that was helping you sell online and in apps. We also have an in-person payments product with Terminal. And then it was helping businesses sell through platforms and marketplaces. And today, the new wave is agentic. And so we're really working arm in arm with the merchants that run on Stripe to help understand what is agentic commerce going to demand from economic infrastructure. I'd say there's two core needs that are sort of bubbling up to the top. One is businesses need to have a way to crisply articulate what they sell, their products, their prices, their inventory, their checkout experience to agents. And just like there's not one model provider to rule them all or one model to rule them all, right? We're all switching across providers and switching across models. We also don't believe that there's going to be one agent commerce solution to rule them all. And so we recently announced the Agentic Commerce Protocol, which is a shared standard shared language, really, that allows merchants to communicate cleanly with agents around what they sell, how they price, and how their products should be shown. We co-developed it with OpenAI. Millions of merchants have already adopted it, and we're really excited to see the traction because a core challenge for businesses of all sizes, but especially small businesses, is making sure that they can efficiently expose who they are and what they sell to these agent facilitators. The second issue popping up, the second need, which won't surprise anyone in this room, is just fraud and growing risk vectors in the context of agentic commerce. And these are really multi-party risks, right? So as the consumer, I want to make sure my payments credentials are safe. I don't want the agent to see them or use them without my permission, nor do I want the merchant to see them or use them unless there's need. As the agent, I actually don't want to be directly in the flow of funds. I don't want to be the merchant of record. I don't want to take on the risk for the transaction. I just want to facilitate the transaction between the consumer and the merchant. And then as the merchant, well, gone are the days when I can just block all bots, right? Those heuristics aren't going to work because they're going to throttle growth. I need to be able to distinguish which are the legitimate transactions from legitimate customers passed through legitimate agents versus which are malicious. So, we recently released our shared payment token, which is a new payments infrastructure that allows the agent to tokenize the payments credentials of the consumer and pass them over safely to the merchant. And as those tokens are passed over, they include fraud scores. The same fraud scores from our Radar product, which has been around for over a decade, to help the merchant understand the validity and credibility of that transaction. So, again, early days, I think as we move down the spectrum of I'm just buying a Halloween costume in ChatGPT to I'm really unleashing agents to go do, most of my day-to-day commerce for me, we'll continue to evolve the protocol, we'll continue to evolve the underlying infrastructure like the shared payment token. But however it evolves, it needs to be an open ecosystem because, again, many merchants need to be able to sell through many agents, and it needs to work safely for the consumers and the agents and the merchants alike.
And I'm sure the protocol supports different payment methods, but cards is what it's starting with right now for the most part.
Yeah, lots of talk of stables today, but many people still use credit cards, believe it or not.
Okay.
So we support over 125 payment methods. And I'll also note, I said open as if that's only open across agents or open across merchants, but it's also open across payment providers. So we are often passing that shared payment token over to the merchant to use on another PSP. That they're operating on. And so we really want to make it easy for global customers to engage in agentic commerce. We support over 125 payment methods today, but we also support the shared payment token used on other PSPs.
I think that's one of the, just to chime in here, one of the focuses that we had when we worked on our standard was something similar to this, which is, we should let the consumers and the app builders and the merchants kind of pick the path of least resistance or the path of optimal outcome for them. And it's one of the reasons why when we were talking about this, I think a lot of the discussion around any agent payment protocol was really, what does payments look like today? And how do we make payments today work with agents today? I think our point of view was what will payments look like tomorrow? And when we think about agents and their capabilities in the commercial realm, what are some optimal forms of payment today that might be small, but we think have an opportunity to maybe have even a head start in this world. And I think that's one of the reasons why AP2 works with X402, which is the open standard that's what's actually been around for quite some time. I don't want to bore people with this, but it's been around since the beginning of the internet, but it's basically an HTTP request that's called payment required. And so in many ways, we actually see stablecoins as an optimal form of payment for agents because they do facilitate all the things we've been talking about today, which I won't rehash. But I do think it is important as we think about what merchants want and what consumers want that we leave the option open to them as opposed to kind of dictating or even just walking them down the path of inertia that already exists in the space. But I do think there's a lot of unhobbling that still has to happen there. It's still early days for sure.
And the internet taught businesses that they need to meet customers where they are, which was online. I think Agents are teaching businesses that they need to meet intelligence where it is, which sometimes is in MCP servers and has a bunch of different, right? And payment methods and payment infrastructure will need to evolve to support that.
So Alicia, going towards stablecoins a little bit, what's been happening there? Like, what are some of the recent developments that you're looking at, and how does that play into this space around agentic commerce?
I cannot agree more that we need to meet customers where they are. And what customers have shown us is that stablecoins are being rapidly adopted. Stablecoins have crossed $300 billion of market cap. And the two that have been adopted, importantly, are open infrastructure stablecoins. They are interoperable. They have deep liquidity. They were built on permissionless networks. And I think that's a really important data point around what we're seeing customers adopt. So they were born from necessity to enable traders and market participants of crypto trading have a US dollar to settle into in a 24/7 market. Regular fiat dollars did not offer that because banking hours were not matching the crypto markets. And so as market participants grew accustomed to stablecoins, it's now opened up this door to payments. And we have three catalysts that have occurred. One is regulatory clarity. And with the Genius Act, and for many of you who have been involved in getting that legislation passed into place, I'm really grateful because it has provided now many market participants the confidence to come and now build in this space. We are seeing growth and adoption of banks, PSPs, corporates, merchants. Everybody's now saying, okay, this is interesting. Let me talk about the benefits of stablecoins and what payment flows those could be uniquely suited for in my business. It's not going to fix everybody's problems. There's going to be a lot of credit cards. I fully agree. Just like we text, we email, we send mail. Like, we have lots of ways we communicate with data. We're going to have lots of ways we communicate with value and we send value to one another. So, but what we have today is regulatory clarity. We've also seen blockchain scaling. And so we now, for example, with Base, our layer 2 solution, we do $1 trillion of monthly volume on Base. We are already at the thousands of transactions per second. This is real. Theoretically, it has no upper limit on its scaling. I think it's important to think about companies that are focused on scaling only, maybe missing security and or decentralization. So this is an important three-legged stool. I don't think it passes notice that AWS was down yesterday and it impacted a lot of access. Ethereum was not down yesterday. Base was not down yesterday. So decentralized protocols show a lot of resilience, and that's something to think about when we're talking about creating payment networks. And there's already things such as optional privacy on Base. The tooling continues to get better. It's much like AI. Like every month, every year, we just see big leaps forward in terms of these technical advancements. So where this dovetails then with agentic commerce, where we're also seeing these big leaps forward day by day, I think that stablecoins, much like Emily and much like Rich said, are uniquely suited to agents. Agents can't open a traditional bank account. Like, that doesn't get through a bank onboarding process. They can open a wallet. They can be programmed. These are programmable dollars where they can set limits. They can white label the addresses they want to pay with. And as you think about the growing types of machine-to-machine transactions that we're going to have, we think it will grow up alongside of human-to-machine transactions or human-to-human transactions. But it's going to be a growth of the number of transactions that we see. And so stablecoins, we think, are uniquely suited to micropayments. Like, it's really hard to do a 2-cent payment through any other payment vehicle that we have. It's cost prohibitive, quite candidly. It's not cost prohibitive in a stablecoin. It's uniquely suited then to, hey, go do some code for me. Oh, you need to go buy compute? Great, go buy some more compute power from Google Cloud. Like, program that in. Moving with speed. So we think there's a lot of very natural problems that will get solved immediately with stablecoins. And we're just at the beginning. And then as our colleagues have shared, each of us, we are all involved right now in building critical infrastructure. We've talked about X402, which is enabling any developer to seamlessly embed payments now. We are building these as open standards. We are sharing these out to the world for others to build because interoperability, adoption, we think will grow to create the most consumer and business benefit. It will lower the cost and create just more inclusion into the financial systems. There will be use cases that will go through different paths, but we believe that this will drive a lot of global adoption of these technologies.
Yeah. Rich, this morning we heard a panelist mentioned the use case of agents scraping the internet and reading content and making these microtransactions. How do you think about that relative to AP2, X402? Is this in that agentic commerce bucket? How do the different technologies support those types of microtransactions?
Yeah, so this is, I don't want to get like too deep in the weeds on the technical side, but like if you're a builder in the audience, right, and you're used to making API calls, and a lot of API calls honestly could be done by an agent on behalf of the user. And so whether it's the sort of the almost like the pay per crawl kind of example that's been used, there's a whole host of others, right? Like we think about it when in the context of even just think about bots interacting with websites or anyone interacting with the website. Really, it's kind of funky to payment gate it for a bot right now, but with X402 or some of these agent payment protocols, you actually could have a bot hit a website, it get a 402 request for payment, and then a micropayment could be made to allow that agentic intelligence to basically have some limited access to the site. So it's, instead of it always being, it's got to be a proof of a human, or I'm blocking it entirely because I'm worried about IP or other things, there's actually now another modality for commerce that can take place. And then in that context, you would think like, well, what is the value transfer that should be paid by an agent for looking at a single website page? Maybe it's a couple cents, I don't know. And in that context, a traditional payment method really just wouldn't make sense. So I think when it comes to anything that involves an API call or hitting a web page, these things can be wrapped by an agent in some ways and then served either to other agents or users who want to interact, and having a common protocol or standard with which they can make a payment, I think is really important. Otherwise, you're just going to end up with really just a bunch of bad phone calls between agents or people and agents trying to get access to a website and saying, oh, well, I only accept this, and you haven't sent me the standard payload I'm required in order to authorize this payment. So I think it's really just about that script. The other thing that I see as an opportunity here is really thinking about how people browse, right, and like the buying experience generally. And so in many ways, I think the agent that we're used to interacting with of yesteryear is this little chat bot that like you go to the insurance site or you go to the Reebok or the Nike website, and those things are pretty much useless unless you really hate this merchant and you want to yell at them and like you're like, I just want to talk to somebody, you talk to the chat. But I do think there's an opportunity where websites can become far more optimized for browsing, where an agent actually helps me navigate the website in a way that looks and is far superior than what happens today, which is I type in something for like, I'm looking for shoes. It gives me a list of shoes that are for men, size 10.5, and I'm just going through very slowly. You could have a personalized experience that I think agents will unlock, where it sort of is doing the hard browsing for you and surfacing up options that it thinks you'll want. So again, that's a situation where the agent is playing a role either by helping the user interface with a system, a website, or with an API of some kind, and then enabling new forms of commerce entirely, right? So the example of the browser looks exactly like what it is today. It's just an agent optimizes it. But doing API calls wrapped by an agent looks very different than what it looks like today. Usually developers are getting an API key. They got to go to the website, they put their credit card in, they get the API key, they go back, put the API key in their coding dashboard, then they access it. And that's just a really clunky experience for things like data or any news feeds, pricing feeds, and things like that. So our view is that it will accelerate in many ways the proliferation of apps that contemplate, we'll call it agentic workflows or machine-to-machine interactions, but it will also optimize what I would consider to be like human-to-digital interactions or human-to-web interactions in a way that perhaps is probably a little bit more real for folks in this audience as opposed to the developer ecosystem.
So we heard a little bit about credit cards and stablecoins, and then the base infrastructure. We're at the Fed, so I'm remiss not to mention FedNow and then the work there also. Because we've been doing quite a bit of work on FedNow and the real-time payment schemes at Modern Treasury. And so I think even there too, when we think about agentic commerce, there's potential as those rails progress around the information that's encoded in the payment rails, the request for pay standard, potentially coming into some of these experiences, opening up other payment methods for the agents. So I think a central message here is there are different rails available for agentic commerce. It's not just any one of them, but there's high standards for what the rails need to support. For Kathy, I was hoping you could talk to us about why this all matters. So why is it good for society, the economy, if we have more commerce going through agents?
Yeah, and I'm learning a lot. Thank you. Oops, here we go. Learning a lot. So thank you to the panel. It increases my confidence that that real economic growth, real GDP growth is going to accelerate. We have had a thesis for some time that productivity gains are going to drive real GDP growth much faster than anyone dares think. And I'll just give you a quick reason. So if you look at, and bear with me a moment, if you look at the period from 1500 to 1900, there really wasn't any innovation. And according to our chief futurist's analysis, working with academia and so forth, real GDP growth globally in that period was 0.6% per year. This was global. Then we had the Industrial Revolution, so three major innovation platforms back then: internal combustion engine, electricity, and telephone. Real GDP growth with that revolution, and that's the last technology revolution, true technology revolution, cutting across sectors. Real GDP growth increased from 0.6% to 3% for the last 125 years. We believe that with the breakthroughs like this one, and the productivity gains, because that's really what you're talking about, that are being unlocked here, that real GDP growth in the next 5 years will accelerate to 7% plus. And productivity gains, of course, now that's a global number I'm talking about as well. Productivity gains, knowledge worker productivity gains, are the biggest reason. We see productivity gains shifting up into the 4 to 5% range, if not higher. So this definitely increases our confidence. I love the open source movement and how, I remember in earlier days in tech, and I've been around a long time, there were fist fights at this moment in the evolution of new technologies. We've learned not to do that, but learned about programmability, interoperability, open source. So again, it's increasing my confidence that the productivity gains that we are projecting coming out of the 5 platforms I discussed with blockchain technology and AI, 2 of the most important, it increases my confidence that these growth expectations will be realized.
The historical numbers are really interesting there too. We see so much investment going into AI right now, but how does that compare to what we saw 100 years ago for other similar waves? Is this normal? Is this a lot? Is it worth it?
Yeah, we equate this to the investment that the massive investment that took place around railroads and the early days of transportation. But what's different about this one is railroads had limits, right? Intelligence and imagination does not. And so we are looking at investment dollars. I know the big question is this another tech and telecom bubble? We do not believe that at all. First of all, back then, the seeds for what we are enjoying now had been planted during the 20 years that ended in the tech and telecom bubble. They were seeds. There was too much capital chasing too few opportunities too soon. The technology wasn't ready and the costs were way too high. We did not get the cloud until 2006. Again, there were gleams in the eyes. I remember them. I was in the business at that time. We didn't get the first big breakthrough in AI until deep learning, 2012. Even bigger, thanks to Google, transformer architecture in 2017. And I can just give you a sense of how off-base investing was back then. If analysts had been using something that is central to our research, Wright's Law, they would never have invested in personalized medicine back then. It cost, to sequence the first whole human genome in 2003, $2.7 billion. We were not at a scalable point, $2.73 billion. Today we're down to $200. And we have, the convergence now of life sciences and AI. So seeds back then, flourishing now, and I think, and this is somewhat contrarian, but it does, again, as I said, it does fit with Wright's law. I think we might be underestimating the impacts of AI. Are there going to be bad investments? Yeah, capital chasing some ridiculous ideas. Always at this point in the cycle, there are. But given the productivity gains we see being unlocked, we see a lot of this investment as justified now.
That makes sense. So, Rich, how, if you're a leader, a public or private institution, company, how should you be thinking about this? Like, what's too early? What should you be investing in at this point?
Yeah, I mean, this is kind of like the ultimate question, I think, if you're at a large institution, whether you're a regulated bank, whether you're in the tech space. So in many ways, I think this type of discussion, like what's happening here, is actually very critical to the next step. One, because it creates an opportunity for people to share ideas in an open way, much like the open standards we've been talking about for the last 30 minutes, right? Not necessarily written in code, but written in sort of communications and emails about, hey, we're interested in making the leap. How do we mutualize the risk with the right partners such that we're all marching forward on this path to innovation and trying to unlock the power of these technologies without necessarily owning all of the risk ourselves? And so I think, not just the public-private dialogue, but also private partnerships. That's been one of the key things for us. And I already mentioned what that meant to us in the AP2 standard, right? It would really not be a good idea, in my view, with all the change going on to basically launch a closed source point of view about how payments and agentic models should work. But even when it comes to some of the technologies we're talking about today, stablecoins in general, our journey has been one of partnership, just straight up. And the reason for that is we cannot do everything ourselves, right? Every institution has its strengths, it's the things it's very good at. It has areas where it needs to supplement where it's not its strongest. And so I think that's been the path here, is like people who are trying to kind of go it alone. I find that they struggle the most. Maybe it's a build-buy partner decision, but that's generally been our point of view, is there are things that we can do well and we'll be opinionated about. AI is one of those things. There are things where we know we have partners in our ecosystem where they're the subject matter experts, and doing a 1 + 1 = 3 situation is actually better than us just trying to do that ourselves. And those are our payment partners, it's the custodians at the crypto companies, it's the protocols themselves. We haven't talked about auditability and accountability when it comes to agentic commerce, but that is where blockchain protocols shine. Because right now, if you think about traditional payments in Rails, there isn't really a public auditable record where both agents of the user and of the merchant would actually be able to verify something happened. And so that's, we are trying to work through that layer cake, offer our own technology where we think we have a strength, and then pull in partners where that works. I think that's actually, probably we all agree with this on the panel, is that there's some things that we can do on our own, and then there's some things where we're a little bit better together.
And I would just encourage all of the companies to listen to their customers. What we're seeing now is that customers are really demanding the products and they are seeking the benefits. And so listen to your customers, what do they need, and then serve them in the best build-buy partner way that you believe that is best for your company.
Yeah, talking to customers, always the best of the best.
Customers always right.
Yeah, customers always right. Kathy, how do you think, for folks here from the public side, how should they be thinking about accelerating this innovation?
Well, if you click,
what's important to support the ecosystem as it's in this moment?
Well, and I'm going to thank Coinbase for its leadership. I remember in the day when the SEC was suing Coinbase, we were sitting there saying, okay, what do we do about this? And your leadership really helped drive the clarity, the regulatory clarity that we are beginning to enjoy now. So anything in that score. I would say, in terms of risk mitigation out there, just from, we're looking at the prediction markets and thinking this could be a real place, again, for more clarity. And we're seeing some, but risk mitigation in terms of commerce, buying insurance for your air flight. I mean, it's a ridiculous cost now. If we bring, it's really bringing consumption and investment together. I think that's a convergence that we're seeing more and more. I heard probably 10 years ago, Jack Dorsey and Mark Benioff talking about this concept, and I'm hearing it more and more up here as well. So this idea that the consumer is involved in deciding how much a risk, covering a risk, insuring against a risk should cost. So I would also say this idea in terms of clarity, but also technology, the programmability, open standards, not putting roadblocks in the way there. I think that is going to be critical. Again, we're hearing this on the panel. And so, I think because our regulatory regime was so hostile, especially against blockchain technology, we're coming through a rubber band stretching, and now it's going because we had a lot of time to think.
We did.
We had a lot of time to think, and it might have been a blessing in disguise. We certainly didn't think so at the time, but I think a lot of very good things are happening because regulators, they understood finally that if we were going to block innovation, it was going to leave our shores. And for goodness sakes, this is the next generation internet. We started that movement. We should complete it, and we should encourage it, into the rest of the world now that the cost of innovation is collapsing as much as it is.
Well, we're going to move on from agentic commerce to other good things that are happening in the world. So we'll get back. I can see from the questions we have agentic commerce questions in a bit. Emily, I was hoping you could talk about how AI is just impacting startup formation, the types of things and people are working on, and what is that demand of the payments infrastructure these AI companies need?
Yeah, so we talked a lot about agentic. Agentic is a sliver of the AI companies and AI work and AI value being done. And one of the things that's fun about working at Stripe is we get kind of a front row seat to each successive wave of innovation. The current wave is AI. And we are a bit of the skeletal system for AI companies. So they use us, yes, for payments, but also for billing and for reaching global customers and for tax. And so, all of the Forbes AI 50 companies that actually monetize on Stripe, and we get this kind of glimpse into what's happening with AI. You mentioned, Richard, the importance of symmetric information. So maybe I'll share a few trends in the AI wave we're seeing, and happy to go from there. The first is just the rapid pace of monetization. So many of these companies are private. And so it's a natural question. Is it a bubble? Is there revenue? Is the revenue real? Maybe only investors know, or the flashy number that someone puts in their press release. But I can tell you from looking at the AI 100, we call it, the 100 AI companies that are highest grossing on Stripe, the monetization is very real, and it's a pace unlike anything we've ever seen before. So to give you a sense, these AI companies, on average, get to 30 million ARR in just 18 months. If you want to benchmark that with the 2018 cohort of equally promising top 100 SaaS companies, that's 3-4 times as fast. And the earlier cohort, right, you get to 1 million ARR, you get to 1 million ARR in less than a year. Again, 4 times the pace of earlier SaaS. And part of that is that these companies are going global basically from day one. Our AI 100, they finish their first year already selling into 55 markets and having the majority of their revenue come from outside their home market. And that might not surprise you if you're talking about a French startup that also sells into the US, but it is also true for US companies selling abroad, right? They're selling models and infrastructure and digital art and music and all sorts of borderless goods and services. And LLMs are really good at translation. So it's really easy to go global fast and to grow revenues very quickly. The second trend we're seeing is actually in the monetization model. So traditional SaaS had near zero marginal cost. So it made sense to sell sort of seat-based licenses. But with AI, the costs, the compute costs, the GPU costs are very real. And so that's breeding whole new monetization models, usage-based billing, right? Charge per token, per workflow, outcome-based billing. Intercom's a great example. They charge per support ticket resolved, which is a great way, actually, to tie pricing to the value that they're creating for businesses. And then most recently, like if you look at the companies, starting up over the last couple quarters, we're seeing a growing swath of what people call AI wrappers. And sometimes this is used in a derogatory way. I do not mean it in a derogatory way. These wrappers are brilliant, right? They are bringing an existing LLM that somebody else has and providing a wrapper with the local relationships and domain expertise and data to solve a problem in a vertical industry, right? So Nabla and Ascribe for healthcare, or Harvey for law, or Studio for architecture, right there. And we saw the same thing in SaaS. Started horizontal like Salesforce, went vertical like Toast. But the move in AI is happening much faster. And the monetization corollary of this is that these wrappers, because they're built on top of someone else's LLMs, have business models that are inherently tied to the cost of the underlying LLMs. So increasingly, we're seeing monetization models that track and price in real time to the changes in the underlying LLM costs. You can think of it as like a percentage on top. So that's the second trend. The third trend I would say is actually stablecoin. We talked a bunch about cards, but like, if you go to Vercel today to use V0, you can buy in stablecoin. That wasn't true just a few months ago. And you can think of many of these AI companies. Shadeform is a great example. They're a GPU marketplace. They're selling internationally, right? So ACH isn't an option. And they have high dollar costs, like you're talking thousands of dollars in your transaction. So international cards are pretty unsavory. You get hit with a 4.5% fee, and you're likely to be declined at that size. So 20% of their revenue today comes from stablecoins. And we actually ran an experiment with them and learned that half of that 20% is fully incremental. As in 10% of that business would not be being done at all if stablecoins were not available, because those buyers did not have access to another payment credential.
I love this chick's energy.
We talked a bit about fraud, but just to state the obvious, like transaction fraud, fraudulent disputes, that's what really matters if you're, a retail company or traditional SaaS. If you're an AI company, you actually care a bunch about your compute being stolen. So you care about the full funnel of fraud. You need to know at the time of sign up, is it a bot? You need to know if the person engaging in your free trials are going through serial free trial abuse. You need to know if the person buying your large enterprise program and then burning down your credits is actually going to request a refund and leave you in the red. And so we're seeing a need for an increasing breadth of fraud-related signals well beyond sort of traditional fraudulent disputes. And then I'll just close with businesses are now being built in AI dev tools, like Vercel, like Replit. And it's not just AI businesses that are being built in AI dev tools. It's all sorts of businesses. And so payments infrastructure now needs to be deeply embedded in those tools, because building a business isn't about building a functioning website with a back end and a front end. It's also about supporting transactions and enabling the money flow. And so we have a new product called Claimable Sandboxes, actually, which just lets you build your business in a box right within your AI dev tool. But I really think in the same way we talked about agentic commerce, consumers wanting to buy in whatever their AI tool of choice is, we're increasingly seeing the same trend for developers.
Can I just add
really not bad,
one
excellent
thing
above
to this
33.
in terms of are we in a hype cycle?
Are we in a hype cycle?
As we've sized it, by 2030, consumer-related, whether it's subscriptions, commerce-related, or advertising. Advertising is going to be a much bigger business. But those
Coinbase
three will add up to, by
Abonde.
2030, $1 trillion in revenue opportunities. And many people will say, well, goodness, we're seeing spending $500 billion by Stargate. And well, that leaves out sort of the enterprise side, and I know we'll probably get to this in a moment, but the enterprise side. And we think between hardware and software, that is between a $8 to $9 trillion opportunity and maybe 15 trillion by 2030. For some of the reasons that you're stating, this is moving so quickly, and it is having such a profound impact on businesses so much more quickly than we've ever seen before.
And what does it demand from financial infrastructure? It demands, seamless and fast spin up of a business to integrate payments. It demands a much more robust and broader set of fraud controls. It demands access to new payment methods, including stablecoins, and it demands economic infrastructure that supports all these new monetization models so that the market can figure out efficiently sort of that intersection of supply and demand.
Right, and just to close this circle, so we're talking a lot about, it's B2B, it's business to consumer. I think so much of the benefits are coming in, productivity gains, and that doesn't show up on the top line. It can be turned into margins, increased wages, increased R&D, or lower prices. And so I think many people don't understand the other ways this can turn around other than directly to the top line.
Yes, Kathy Wood, yes.
Alicia, we heard Emily mention stablecoins as part of that flow a second ago, and I was hoping to just go back to that to talk about
I like this guy.
fraud as it relates
He
to
keeps
stablecoins.
going back to
How should
stablecoins.
businesses
He's
think
like,
about that?
let's go back to
Is it more
stablecoins.
or less than what they see
like
with
it.
traditional payment rails?
I like that guy.
It's the same problem with different solutions. So fraud exists in all payment
Who is
types.
that guy?
Fraud's existed in credit cards, in checks, in wires, in cash. So there is fraud in stablecoins. However, stablecoins introduce a whole new set of tools to combat fraud. And I think it's important to think about those as opportunities. It's the first time you can see on-chain and permissionless networks the entire payment flow. You can use then AI and machine learning to look at payment activity and really have better informed fraud models that you can do proactive risk management on. You have the ability for whitelisting and blacklisting various addresses on a personal basis, at a company level, at an economy level. There's also a concept of freeze and seize, where if a stable coin ends up in a bad address through proper law enforcement and through proper judicial proceedings, you can freeze that asset and then remit the underlying dollars back to the fraudulent actor. The other thing with
it's not
merchants is these are
decentralized at all.
final. There's finality in these payments. There isn't a concept of chargebacks with stablecoins. And so from a merchant standpoint, this is a benefit to them. You can still then have different processes to then have reimbursement. But the key here is the tools only get better. As I mentioned earlier, this technology continues to evolve and build. And we are in the earliest days of looking what fraud prevention is, but we actually see less fraud, quite candidly, on our own systems coming from stablecoins versus from traditional fiat. The other benefit, just to Kathy's point that I wanted to add on, is in the spirit of where the value accrues, the efficiency of building with AI and with blockchain is just a brand new paradigm of efficient build. And just a quick anecdote, in looking at reconciliations and making sure that we are then ensuring that the transaction was legitimate, my own team can reconcile our crypto transactions, one person, half a day. It's basically all automated. It takes a team of 15, like 3 full days to reconcile our fiat transactions with all of the payment. So your back office costs, your settlement risk, you just take a lot of risk of settlement and risk of reconciliation out of the back office that accrues to the bottom line.
Does that
With
end up,
stablecoins.
that ends up helping you just build more at the end of
Correct.
the day? So, I mean,
Correct.
Coinbase pushes out a lot of product.
It
Seems like
does.
this probably helps.
It's all about efficiency, productivity gains. We can see by the end of the year, half of our code will be written by AI bots. And so that's the equivalent of almost doubling our R&D workforce.
Wow. Yeah. Kathy, I'm sure you want to touch on that. I mean,
Oh, no.
what are the implications of that? I mean, there's a lot more innovation being driven by AI-assisted engineering teams, a lot more
Yes.
R&D there. What was the result of that at
It's
the
the
end of the
first,
day?
sorry, Matt.
Go ahead.
It's the first place we saw how provocative the productivity gains were going to be. And that as we were doing our forecasts, we were having to raise them, as some of the early building blocks came through. So, and it got
We're
us to
cooked.
thinking more about that GDP growth number.
Yeah.
The productivity gains, again, can be turned around in so many ways to drive to drive real GDP growth. So this panel is increasing my confidence in that forecast.
Yeah. Awesome. Well, I think we can move on to the Q&A. Just a reminder, folks can pop questions in here.
Pop them.
I'll take a look as we go. But there are two questions that are sort of similar on here, going back to agentic commerce. They're a form of what are real world places where you can actually use an agent, so use ChatGPT today to make a payment. I'm curious if anyone on the panel has bought something with an agent. We can start there as an anecdote, but otherwise, where are places we can actually use these today? Go ahead.
So I really did
she
buy my
has.
6-year-old's
Emily
Halloween
has.
costume on ChatGPT instant
course you
checkout. It hasn't arrived yet, but we still have like another week, so I feel good. No, it'll come.
I like her.
I have tried using Perplexity's travel search and booking agent. Actually, the Paris example, I was going to Paris for a Stripe tour in Paris, and then I was staying with my family, and it gave me great recommendations. I did not do the all-in one-click package, but I could have with one click had it buy my flights and buy my hotels.
Was there a reason you did it?
The reason I didn't is because my work had already booked my flights, so I actually didn't really need the full package. And then 𝐕𝐈, Bill Gates' daughter's startup, is actually really cool. You can use it it's agentic shopping, but it also does like price compares. So it's sort of an always-on agent to figure out the best price for you. And then there's a bunch of niche-y ones. So one that I like is Barista Agent. If you have like specific tasting coffee beans, but you want to broaden your aperture, it sounds really niche, but I think it'll just give you a sense. Like there's not going to be one agent to rule them all. You go and you tell it like your preferences. I like kind of chocolatey beans, and then it goes out and it like scours the internet.
Yum's
but
open.
you have this conversational interface to engage around your bean preferences, and then it buys it, and they literally showed up at my door. So I think there's a lot of examples in the consumer space, in the B2B space as well, right? You can buy or sell from within Cursor. You can spin full businesses in V0 with a complete Stripe integration and claim your integration. So I think we are on the path, and I think it is still quite controlled, quite deterministic. Humans are still generally making the final call for the basket of things they are buying. And it'll be interesting to see kind of the pace of evolution.
Yeah, I think it looks a lot.
Who the hell's this
It
guy?
feels very similar to me when I was younger and buying things on the internet, and you're like, I don't know if this is actually going to get here or not, but I hear this is really cool, and my friend said that they ordered it and it showed up, and I think it just will take time for consumers to build. Again, we go back to this point of trust, but also these behavioral patterns around shopping with agents. What we see is very similar to what Emily said, right? We see a lot of what I would call like paved roads already that kind of unhobble some of these issues that I think we've kind of spotted throughout the panel, where more work needs to be done. But there is a ton of interest. Like one of the demos that we did live, actually I think it was on stage at one of the Coinbase events, was somebody basically using their agent, their Gemini agent, kind of troubleshooting an issue in their house, which is, for any of the dads here, this is probably something that's near and dear to your heart, at least it is to mine. And there's a problem, and they're talking to their agent, and their agent says, hey, give me a second, I'm going to go and look for some agents that deal with home improvement. A Lowe's agent comes into the picture, basically diagnoses the issue, and then it gives him a list of options that he can purchase for this new part. I think it was an appliance or something. And you can actually, the way that we do these demos is we unpack it so you can actually see the messages between the agents, and you kind of almost get to look inside the transactions themselves. In a consumer context, you're not going to see all of that. It's going to be abstracted away. But just in that demo and in that work stream, you can start to see like merchants are realizing how much it will increase the velocity of consumer transactions. It's also going to change the patterns of consumer behaviors, right? Are they thinking about big box stores, or are they thinking about showing up here? And what I will say is every single merchant we talk to has an agentic commerce strategy, because they realize that people are no longer necessarily going to be walking into the stores, but maybe accessing their website via an agent of some kind. I think the other area where I see it that we've started to tinker internally, and shout out to some of the stable coins that we use like PYUSD, is actually playing around with treasury management. That's a really nice safe space because you're within the four walls of your institution, but you can have agents essentially move money from cost centers without really, again, exposing yourself to what I would say is like all the real world counterparty risks that might be involved in a B2B transaction. And so those are the types of examples that I think are quite interesting, and probably we'll see more folks work on this. But I have to say, in the crypto space specifically, There are teams that have run at this 1,000 miles an hour, and I know there are teams that
all of you were
you can use their agent. And by the way, you bring your own agent if you want, to buy things on Amazon, like order snacks for the office. And that, I think, is, again, they're doing, I would say, all of that unhobbling work. That it takes a lot of time, but we're going to start seeing people do that at an aggressively faster pace. I think the merchants will try and meet them in the middle as they see consumers prefer this path.
I'll just add on, in crypto, you can have an AI financial advisor that goes and buys crypto, buys the dip, manage your wealth portfolio in crypto, executes all your transactions, and we have a lot of employees internally who will test the bot against their own investments. And so they'll be on chain saying, did I buy the dip right? Did I invest in the right dollars? So it is moving very quickly, and I think that you will see use cases expand. And I agree with Emily, there's going to be multiple agents that serve multiple use cases, and I think that consumers really are going to lead this wave, and then you're going to see businesses follow up with products and services to augment and support them.
And I'll just add one thing there. That's very important because we think the consumer is going to move much faster than enterprises. Many people think this is about using tools in enterprises. No, it is not. It is about reimagining, reconfiguring your business. That is going to take time. You work with Palantir. We're only 70 people, and we're working with Palantir because I feel like this is so important and such a big opportunity. And, we're doing this kind of away from the CTO. He's involved in it, but it has to be kind of orthogonal because the whole opportunity is orthogonal. So the MIT study that came out a month or so ago saying, hey, nobody's seeing productivity. This is going to be hard work to set up and really transform. It's going to take time, especially for the large enterprises.
There's a question about what are the labor economics implications of these productivity gains? Are they offset? So it sounds like initially not as much, but over time, much more so.
What's very interesting, and we're experiencing it in our own firm, I thought we wouldn't be hiring many people, but we're hiring more people now. Why? When I go to the finance team, for example.
Finance.
Why? This is the easiest thing to automate and with AI. And the answer is we don't have time. So we're hiring very young people who are AI natives, forget digital natives, AI natives, coming in and empowering them to make this happen. So, but in terms of labor, I think there's a bigger question. The history of technology is it is a net job creator. Sure, there's displacement, but boy, talk about the best time this could happen. Baby boomers, I think, are retiring. I'm not sure if this is quite the right number, 1.3 million per year. We have immigrants, let's just say the immigrant population growing much less rapidly and maybe shrinking in here. And so, you hear about truck drivers, you hear about transportation, hair on fire, that's such a big employer. They are, these businesses are being hurt by a shortage of labor. So we think, if you put into OpenAI or Grok, one of them, what jobs are going to be created in the next 5 years
Jobs are not going to be created by AI.
I
think that's obvious.
And you'll have to prompt a little further and say, we want you to use futurists, science fiction, sure, strategists, economists, technologists, all of that. You'll come out with a huge list of jobs. I highly recommend it.
Yeah. Another question we have here is, how is consumer privacy improved or at greater risk with agentic payments made with stablecoins? I don't know if anyone wants to take that, or Rich, it looks like you got something.
There's a couple things that I think there's a real opportunity to kind of improve the privacy surface area that consumers have vis-a-vis the merchants, right? So everyone kind of knows the story of they put some information into a website for a merchant or financial services provider, that individual or that entity has suffered a hack, and then all of a sudden you have this issue. And so you can really start to create ways, and this is where it dovetails really nicely with some of the innovations that are happening in the blockchain and generally the cryptography space. We're experimenting with the idea around basically delegating authority to an agent to reveal certain private information, perhaps to another agent. It could be a user on the other end, without actually having to reveal the credential, right? And this is what we call zero knowledge proofs. Google Wallet now allows you to do this with your digital state ID today for age verification. And so the very simple way to put it is, traditionally we're very used to basically this idea of giving our information to a third party and then they just keep it forever. And the analogy that I like to go back to is it's kind of like you walk into the bar and instead of them just looking at the ID and then they give it back to you and you go get a drink, they hang on to it forever. Even when you leave the bar, they still have your ID. And that's crazy. But that's literally what millions of people do every day. And so zero knowledge proofs kind of create that situation as it should work at the bar, which is they verify your age. In fact, it's even better. They don't even see the rest of the information on the ID. They would just know this person is authorized to be in this location. And then they have what they need from the merchant responsibility standpoint. And you as the consumer don't have to worry about the honeypot risk. So I think that that chain of trust that we talked about at the beginning of the panel has an opportunity to make giant leaps, both as it relates to privacy, but also consumer control along the way. So that's one of the areas that we see opportunities, particularly as it relates to like identifying information or identity.
One question we just got, I think we can end on here too, is for Emily, just how do you protect the less tech-savvy users in these types of situations from people who are trying to drain their wallets, get information they shouldn't have?
Actually.
Yeah, so I mean, in the case of agentic in particular, that sounds like. So this comes back to our shared payment token. So we are actually passing over the tokenized credentials needed to make the transaction for the product on the merchant that you have approved, and nothing beyond that, full stop. And before the shared payment token, we actually used an approach that's not dissimilar to financial infrastructure-wise how we approached human agents. So like someone here has ordered from DoorDash or Instacart or something today, right? So if you like ordered from DoorDash, at the time you bought, you provided your credit card information. And then your DoorDash driver, who I'm gonna call a human agent, and then we'll talk about AI agent, was issued a single-use virtual card to spend on your behalf. So they didn't see your card credentials. They couldn't go buy whatever they wanted for themselves. They could buy from Starbucks near your location in the next hour for the amount you approved. And neither the human agent nor the Starbucks ever saw your card credentials. And actually our early versions of agentic commerce, before we had developed the shared payment token, used that same Stripe issuing product, single-use virtual cards, to accomplish the same thing. And so I think economic infrastructure has come a long way, but it hasn't come a long way overnight. The first version of agentic commerce was actually made possible by infrastructure that we had built for human agents, like these delivery drivers, so that they could operate on your behalf. And the only thing that's changing is you swap in the human agent for now an AI agent, but the protection mechanisms are actually quite similar.
I think the other thing that I'll just maybe say here about consumer safety is there's something in crypto that we talk about, which is building in public. And the benefits of building in public, right? This is something brought up and bringing it full circle to the DeFi panel, right? There are benefits to having these protocols be transparent and visible and auditable. And so in a lot of ways, I think the idea is that for the consumers who are savvy and they want to unpack that protocol, they can do so. But for the folks who are building applications where they have the touch point to the customer, there's an ability for them to be transparent to their end user if they need to, and also create that level of trust between the consumer, the application, and the underlying infrastructure or the guts. And so you have to do this balancing act of making the infrastructure invisible, right? People don't need to know how the roads work or how they were built in order to drive on them. That would be a painful process. But you also want to make sure that there's confidence in the safety of that infrastructure that they're passing on, say, for example, a bridge. And so in many ways, I think the idea we're trying to find is, with our service providers and partners, the right level of balance between giving users access to transparency, but also ensuring that they have the right controls and safeguards visible and apparent to them whenever they're using the application.
Awesome. Well, I think we're good to wrap up there, time-wise.
They have another one.
Thank you again. Thank you to the Fed.
Thank you. Actually, I was bored in the beginning. Now I'm starting to enjoy myself working on this tweet here. This is a great tweet. So gold lost almost 2 trillion in market cap today. Bitcoin's market cap is about 2.2 trillion. I don't know how to finish this. I don't know how to word this, string this together, but kind of like this concept, you know? It's like if gold can shed that much, then like these thoughts of Bitcoin's too big to move like are clearly wrong, right? I'm gonna keep working on that. We have another topic. I guess it resumes at 2:30. Oh, that's cool. We could have like 30 minutes to vibe. 30 minutes to stretch my neck because it keeps being tight. What's the next topic is the question. And it is tokenized products. So maybe that is worth watching. What do you think? Let's do a vote quick. I don't know how many votes we'll get in like a few minutes, but let's pop it. Let's close this one. 600 votes. And realistically, the last poll was about stablecoins. They've been talking about stablecoin adoption, right? And while they may be referring to institutional, whatever, behind the scenes payment rails kind of things, I asked in chat, are stablecoins being adopted? And what I mean by that is, are more people using them? I mean, yeah, people, not companies, not institutions, not payment rails. Is everyday Joe using stables? And obviously no, but are we seeing any adoption? Have you ever met anyone who uses stables that isn't in crypto? Obviously not. No. I use stables a lot. You guys may use stables a lot too. They're great. I'll be real. But that poll was interesting because the real adoption is clearly not there. Let me put into the poll, should we watch the tokenized products? Maybe this is where the chain link people come in. Segment 2:30 to 3:30. Yes, no. Yes, no, vote no. Yeah, obviously not. And it is disheartening that every time we hear every time we hear the government or the Fed or really any of these people talk about crypto in any capacity that matters, any meaningful capacity, not just briefly mentioning something, right? It's about stables. It's always about stables. It's never about Bitcoin. It's never about your coin. It's always about stables. Something to think about. Vote in that poll really quick, guys. Everybody here, if you're tuned out for a second, if you're, I don't know, you have this tabbed or you have it on your headphone, really quick, tune in, jump in the chat and just vote. Should we watch the next segment? The next segment will start in 24 minutes and it will be tokenized products, which could be interesting. The one we just listened to was AI and payments, which could be interesting, but I think at the end had some interesting stuff, but most of it was very dry. Vote really quick and we'll decide. What we're going to do. In the meanwhile, we could work on this awesome tweet I got to do this tweet. This tweet is so good. I love it. I don't know how to word this. Sometimes I get stuck at the end. I'll leave this up. I was maybe signaling to you guys a few things during that talk there. One of which was the Windicator. It's our new premium, ultra premium, actually. It's our new ultra premium quantum. I'm trying to think of other buzzwords. Black box indicator. And it has so far 100% hit rate. It flashed. This was, yesterday it flashed? Wait, this was on Friday? I don't know. I don't even know what it was. Yeah, on the 20th here. And then actually 8 hours ago, it flashed again and it gave us a gold down, Bitcoin up signal. Very rare, very nice. This is the complex black box data. Don't read too much into it. It's not really for humans to digest. It's a little complicated here. And 8 hours ago, what you will have found is Bitcoin has rallied off its low. Let me see, 8 hours. It's 10 hours, so like right about here. Close enough. Off its low 6% from 107,000 to 114,000. And in that same time, gold has shed trillions in market cap. Gold down, let's see. 8 hours ago. Gold down from 4,200 all the way down to 4,000. It changed about 4%, 5%. So the Windicator, it's trademarked as proprietary, guys. Don't even. I will lawyer you so fast. Don't even. The only way to get it is to make sure you're subscribed and followed on all social medias. It is not for the public yet, but I will be sharing as these signals fire off in real time. There's no way to know when they'll go off, but as they do in real time, I will try to update you and I'll get you that information. If you're following, have the notifications on. You don't want to miss them. How funny would that be if I started selling a Windicator? It's like premium Windicator. That'd be hilarious, dude. 42 stables for taxes. You can still have assets. 42 stables for taxes. What do you mean by that, RPM? Oh, by the way, another really quick mystery while we're waiting for people to vote. 89% yes. It's looking like yes. So the curse of the @ symbol. We're still here. Maybe I should stop calling that. Maybe I should stop calling it the curse of the @ symbol. So some of you have commented over the last few days and weeks, giving me kind of info that you've seen. So some channels have this, some don't. Most of them don't. I was trolled by this. I was actually about to reach out to YouTube support because I couldn't figure out what's going on, and I don't like it because I don't know all your names. So this is your channel tag. It's like 𝐂𝐽, my guy, you and Sophie out there. Your channel tag is the same as your channel name. That's good. What this means is you all should go do this. Go to your channel in YouTube, like click your icon, your name, and go to like your channel, and you can set your channel tag. You should grab the channel tag you want, because during this live, I figured out. So Chris Back still has names, not ats. During the live, I found a published piece of content from YouTube from June or July, and it explains it. So they are doing what they always do, the A/B test. They roll stuff out to some and then not to others. They see how it goes. And so they are been kind of testing the waters here. The plan is for them to roll this out on every channel. So I guess we have it early. I don't know. It's kind of shitty. I'll be honest, YouTube. If you're listening to me, it's kind of shitty because as someone who does live stream, we have a community here. You guys might not recognize each other's names, and you might not think your friends are here. You might not think the crew's here, and that can hurt community. Just, giving this for YouTube. But on top of that, as a creator, I have taken so much time and effort to memorize and like learn who you guys are, know who you are, especially the regulars. And some of you don't have your channel name as your username. And so I don't know who you are. And that's not good. That's bad for engagement. It's bad for community. But here is the gist. They're almost certainly moving to this. If you look at YouTube comments, they already have rolled this out. YouTube comments are these. On every channel, I believe it's not usernames, it's the ats. I think they will roll these out to all streams, all live streams, all channels. It says it in the video that that's the plan. The video's old and hasn't happened yet, so who knows. But the reason being is these are unique. These are unique. There's only one Janix89. There's only one The Pickle 5610. There's probably 5,600 The Pickles, but there's only one The Pickle 5601. They are unique, and that means that people can't have the same name. Currently, under the non-@ symbol, you can make an account Tom Crown and come in and be like, I'm Tom Crown. Obviously, that would be hard, but people can impersonate other. There's no unique identifier, and that's what these are. So what you should do is go to your channel, and you can change your tag, but remember it's unique. So you want to do this earlier. You don't want to do this. You don't want to like wait and have, I don't know, whatever name you want picked up, right? David Brum, do I have a link for the video? Yeah, I'll shoot it to you on Twitter. It's from YouTube, I think. Yeah, I'll shoot it to you on Twitter. Next up, this is the Fed Innovation Conference. We're voting currently to see if we're going to cover the next segment. It's about an hour. It starts in like 15 minutes. The next topic is tokenized. Tokenization of asset. Tokenized products. Sorry, I was trying to remember it. Tokenized products. That is going to feature Jenny Johnson, the CEO of Franklin Templeton. The last board was stacked. Don Wilson, founder and CEO of DRW. I don't know what that is. Rob Goldstein. This is probably the biggest name that we've seen so far. Rob Goldstein, the Chief Operating Officer, the COO of BlackRock, will be on that panel. Moderator Colleen Sullivan. I don't know, Howard Digital, something. And then the final participant will be Kara Kennedy, the co-head of JPM Nixies. I don't know what that is. And then closing remarks, which will be done by Fed Governor Christopher Waller. Oh yeah, by Waller. This is at the Fed. This is a Fed conference. Trip Howe is not speaking. He will be speaking next week on Wednesday, the 29th, at the FOMC that you're all going to be here for. Everyone should change their tag to Crypto Sharknado. Oh, no Sharknado. I think you... They're unique, bro. Nobody else can have it. That's why I said chief of operations. Thank you. That's why you should change yours. You should claim the one you want, so you don't have a bunch of gibberish. What's up, Lucas? How are you, my friend? Should you change your name to Tom Crowns? And people might get confused. I mean, if you want, sure, I guess. So luckily, not luckily, but creators like me who have grown their YouTube, fortunately, I'll put something in chat here, get a little check mark next to their name. So even if someone were able to take Tom Crown, you would know it's not me because it doesn't have a check mark. Yeah. Anyway, you changed your @ there you go, Milk Slurper. Yep. So we got like 10 minutes until the next segment on tokenized assets comes up. If you're jumping in, I'm pointing out and talking about these @s. This is probably going to be rolled out. YouTube is going to be rolled out to every channel for these live streams. Some of you guys have kind of, I'll say, less unique ones, right? John Doe -GV2KQ. There's one. There's many. Go to your channel. Click your face on, like, I don't know where you are, if you're on a phone or PC, but click your face in the top right corner, wherever it is, and go to your channel, and you can change your @ It is a unique name. Nobody can take Tom Crown because I have it. Unlike how names are currently in live chats where everybody can have the same name, which would be funny. They're unique, so go claim yours. Get one before, I don't know, whatever you want is taken. These are going to be rolled out for everything. Everyone streaming should get a mark in their own chats. They do. Like, if you do a live stream and you chat, your name will have a yellow box. Like, everybody gets that. Everybody gets the yellow box. But in other streams, I'll have the check mark simply because my channel is YouTube verified. Very, very cool, very classy. Let's see. Where are we at? Gold and silver on their biggest down days ever. I wouldn't hold my breath thinking that's going to continue. These things, I think, are still monstrously bullish. Wait, what happened here? That was like right to here earlier. I don't understand. Sometimes TradingView does some shenanigans. Like, even there, you just saw a change, even though it's the same time frame. I don't get that. 𝐂𝐻. Well, we have a second. 𝐂𝐻 looking very strong still. We talked about this yesterday. I do believe, was it yesterday? Yeah. Literally. Not usually live on Tuesday. We talked about it yesterday. Looking for 𝐂𝐻 to retest this high from earlier in October. We said it looked very strong. It was interesting because the rest of the market didn't look quite so good. I placed this long at what? 260. Obviously, TP has not hit yet, but long filled in the right direction of the trend. We do see this 4-hour candle reversing at that resistance, back testing perhaps the resistance from earlier. I don't know, earlier Monday. This looks still good. And actually, if you watch that stream, or if you're there for that stream, I did say 245 is probably the better entry, but I'm just going to place it here. Exactly. I mean, perfect. Wicked to 245. You might have not gotten the fill though. So the 260 might have been the right trade. But anyway, perfect. Moving up, I think 𝐂𝐻 has more upside here. Looking for a pretty quick move to 393 if it actually closes above 291 there. That is mirrored or strengthened. The argument is strengthened by 𝐂𝐻 BTC, its value against Bitcoin. Last week closed as a little doji. This week now with a higher high engulfing that previous candle. I think it is looking to make a move up to 0038, which is a huge, wow, that's huge. I don't know if I can make that call. That's a huge gain against Bitcoin. It's a 60% gain. Where would this be? Okay, well, 393 is actually a 40% gain, so that might not be that crazy. That's actually big. I don't know if I want to make that call so quickly. This is the weekly time frame, so it could take, could take days. It could take a long time. Might not be a quick move on the BTC, on the BTC pair. But 𝐂𝐻 still looking awesome. Nothing else really looking great. Specifically, 𝐂𝐻 kind of taking the show here. ETH and FBTC recovering. CME gaps kind of still here, not really doing much. Well, we have a minute. Let me just throw in some of this TA while we have a second. So I have too many charts. I really need to delete charts. I need to take a day and just delete a bunch of extra charts so I can navigate these a little more smoothly while we're live. There we go. This is what I wanted to show you, or this is at least the gist of it. So, damn, we hit 14.1 today. We have been talking about the big boss, the final boss, right here, 115.3. Now, we did reject from it earlier in October. We did talk about a potential short there, but I think I was still kind of reserved for up here at 18.5. This price, 115.3, I still think is very likely again. We've gotten close to it already. No matter what, whether we want to break to the downside or continue to the upside, 115.3 looks so juicy. All of our major moving averages on the day sit right here. All of these blue squigglies, which I know is kind of a headache, are all of our VWAPs, our volume weighted average prices that we've been following over the last few months that have been very great guides, all sit at this level. This is the liquidity level. If you look back for like 200 days, you will find that the average, not even more than that, the average price that Bitcoin has been bought and sold at sits right there. This is it. If we break above 115.3 and hold, I don't know, close the day, anything above the 13th of October, I think we're moving back to all-time highs. It may be more of a move like this, could be quick, many different ways I can play out, but this is the boss. Move through 115.3, close above it, hold it, and this sell-off is over. I did say on the 10th of October, the bottom was in. The bottom is still in so far. I know on that chart it didn't show that. The bottom is still in, though, on the pairs that saw the biggest sell-offs, right? When Bitcoin hit, 102 on Binance, on USDT pairs on Friday the 10th, bottom in has not been invalidated. We are still in a bear flag, so it's not quite celebration time. Again, it all falls on 115.3. So far as held, I still believe that to be true. I still believe we have more all-time highs coming into the end of this year, maybe even this month. It's really not that crazy. Gold has bounced against Bitcoin has bounced against gold at exactly the point we had talked about. This is pretty fire there. On the exact trend, it has bounced in the last two bear markets. Boom, here we are. I mean, that's a long way to go, but I'd like to see that continue. It is interesting that right as we hit this trend line, basically gold, silver pull back on their biggest sell-off days, and Bitcoin finds bids out of nowhere, right? It's very spicy. Not looking so great right now, actually. It's looking pretty droopy, but that's okay. I think we only have a few minutes until this resumes. These tunes, mad tunes. A few minutes until it resumes. I don't know what to do. I should go to the bathroom quick. Yes, 81%. Not a lot of voters going on. 81% though. They're saying yes, I'll take it. So I need to follow up with some other crap. Following up with some other crap. Some of these craps, okay. Yes. Change your name. There you go, 𝐕𝐲𝐻. You did it. Nice, dude. So many crypto Sharknadoes. So many. Crypto Sharknado 1. Dude, that's actually funny as hell. That's so funny. I will warn you, I don't know how many times you get to change it. I know that it's not like you can only change it once. I know that isn't the thing, but I don't know. I wouldn't do joke ones with these. That's the whole point of them. The whole point is that like it's supposed to be a unique identifier. I wouldn't mess around with it unless you're okay being stuck as whatever name. Okay. You changed it 3 times and now it's stuck for 14 days. Okay, that's not bad. OnlyFans CEO. People don't want AI generated content. Bro, people don't want AI generated content anywhere. It's not just OnlyFans. John Doe fecal matter machine. Yes, it did work. People don't want AI content anywhere. Maybe like children do, because I don't know. Maybe like babies that are growing up with it, maybe. Maybe. Nobody wants AI content. It's garbage. It's just like AI answers. You know, actually I had something I wanted to say while they're talking about AI. So do you, have you guys ever noticed, you know how you ask AI a question, right? And no matter what you ask it, it will give you an answer. No matter what you ask it, right? And a lot of the time, these answers, they'll sound good, they won't make sense, or they'll just be straight up hallucinations or make shit up, right? But have you ever noticed that no matter what you ask AI, it will never say, I don't know. I don't know the answer to that, or I don't have enough information to be able to answer it. It never says that. Think about this. Have you ever asked AI a question? It says, I don't know. It won't. It won't do that. And it's not because AI doesn't, it's not because it has nothing to do with whether it knows or not. It's because AI does not know or not know anything. It is not knowing. It is just like mimicking and pulling and answering with like things that fit. So it isn't aware. It doesn't have the ability to comprehend if it knows or doesn't know. It only is able to spit out answers. It is not able to determine if it understands and knows the question. Something interesting. See that South Park GPT? Is it the newest one? I haven't then. It's just a debate. It's just gibberish, dude. It's such slop. It's such slop. It's such slop. I got distracted here. I had like a few things I needed to do. A narcissist? I don't even know. It's just not thinking. Everything that you can think of has already happened in the past. It just gets rediscovered. Maybe. I can say with certainty that everything that's ever happened or been discovered has already happened in the future. It's already happened in the future. For sure. What's up, Crispy? AI kisses ass too much to answer you. Well, it's because it all it does is make answers that you like. It doesn't make good answers. Ask it anything complex about crypto and it's just makes shit up. People were so bearish yesterday. It's wild. Wild. App will continue. What else we got? I close that. I don't care. It was right where it was. All of these all the other pairs right where they are. Closing it. Gold, silver trade operational. Hopefully, I mean we didn't get stopped out, but I don't know where to put the stop on this one. Looking for that back test of silver at 50. Easy play is like a magnet. Just comes right down and fills. Stop on this trade though, looking at like 46, 45. The TA gets so hard, or TA gets maybe like just less predictable or less probable when you have things like, I don't know, the way gold's moving. How do you do analysis on this? And the answer is your tools are limited. When things are moving just up, when they're just trending so heavily in one direction, it's like you could maybe look for like low retracements, look for, I don't know, 618. I don't know. That would mean bottoms in, go long, right? Our tools become less helpful, and kind of a different concept becomes more helpful is don't fight the trend. You see something like this, and unfortunately, you just have to look for longs. You really don't, in my opinion, don't want to be looking for shorts on something trending like this. And then where do you look for longs? Is not easy, man. It's not easy. You don't tend to see clean moves that will allow you back in when markets are trending this way until it's over, until the trend's over, until until it reverses and you get these fills and you're like, oh yeah, awesome, I finally got them, we're going to the moon. And then it's just done. I don't think gold is done, but like, how do you TA this? Like, what are we going to do? You could have bear div all the way up. It doesn't matter. It makes no difference. You don't even have bear div all the way up. This thing's just cooking. Phew. Cooking. I'm sure you do if we zoom out to a big enough time frame. Maybe not. The weekly's still cooking. Jesus. Jeez. Forgive me. The monthly. No. No bear div. No bear div. 91 on the month. Shorting gold is crazy. It's a crazy concept. Eventually it'll work. But that is, in my opinion, just such a losing strategy. I don't really know what to do with this. I don't know how to like come up with anything. Silver trade was easy. Look for that previous all-time high test. Easy. Gold, I don't know about that at this point. I don't think it's going to go back to its previous all-time high test. At least not in a satisfying clean move. Maybe we look at this 4,059. It's pretty close to price. It's pretty close to 1,618. You got a retracement. It's a pretty deep retracement for such an uptrend, though. Maybe we have to pull it deeper. I don't even know, though. Like, I don't even think that's a great idea. I don't know. How do you TA it? It gets hard. I remember back when Bitcoin used to be this way, and it's like, I don't know why you're trying to throw all these lines and stuff on it, man. Like, shit's cooking. It's like, just look for longs. Look for longs until it stops cooking. Gold. Bitcoin looks very droopy here on this low time frame. We are on Kraken. Let's go over to Coinbase. It shouldn't look any different, but same thing. This is not a great setup. Very low time frame, 5 minute on Bitcoin. Very zoomed in. And what do we have? One of my least favorite patterns, at least, to see when I'm looking for more upside. Test, lower high test. Lower highs, lower highs, lower highs. I wouldn't call this a flat bottom yet, but I don't know. It's starting to look that way, right? It's starting to look like a move downward. Oops. Yep, we're resuming. Perfect. I wasted time.
Rights. Other tokenized equities are issued natively on-chain, where the token itself is the security recorded on the blockchain. Our synthetic and natively issued tokenized shares of Tesla, fungible, both with each other and with traditional non-tokenized shares of Tesla stock. If they're not, what does that imply for liquidity and potential market fragmentation? Would a venue like the Chicago Board Options Exchange and its clearing firm, the Options Clearing Corporation, treat synthetic and natively issued tokenized public equities the same for purposes of writing covered calls and callers? These distinctions matter. We're now in a place where traditional finance brings scale, capital, regulation, and the world's deepest markets, and crypto brings transparency, programmability, composability, and efficiency. Together, I think they form a financial system that's stronger and more resilient than either would be alone. However, as this convergence happens, and as we now move into markets operating 24/7, 365, we need to ensure that the foundation of this new joint market infrastructure is stable, secure, and interoperable, and that it doesn't lead to fragmented liquidity, lack of fungibility, fragile collateral, and loss of privacy. So my hope today is to go a layer deeper in tokenization, and we certainly have the right panelists here to do that. So I'd like to begin by asking each of you to introduce yourselves, and if you could also share examples of what your firms have done in tokenization and the benefits that have accrued to your firms or your clients, as well as some of.
Okay, we will listen to them, but I just want to shout, Nemo, yes, this is my biggest problem with AI. It's not AI itself, it's data centers. We should not allow data centers to just be built around residential, around anything. We should not subsidize them. They should be subsidizing the grid, and they should be subsidizing energy around the places that they're being built, especially around people. They are taking a finite resource that we need, and they are driving up the cost of it. I'm not really super against that. It just should not be subsidized, and it should be subsidizing us, not the other way around.
So if a hedge fund owns it for 4 hours, 22 minutes, and 36 seconds, you will actually get the yield for that amount of time. And I used to run our technology group, and we used to have record-keeping systems and none of them, because they're all batch process, allowed it. So it just creates so much flexibility. We also run validators on 30 nodes on, I think, 11 layer 1 platforms. And we have an asset management business within our asset management business that does model portfolios with tokenized crypto products. And we have a venture capital fund.
I'm Don Wilson. I'm the founder and CEO of DRW, which is a proprietary trading and markets innovation firm. We also founded Cumberland, which is our crypto trading arm, in 2014. So we were very early to the space. I think of crypto as kind of a warm up for on-chain TradFi trading, and we're focused. We spend a lot of time thinking about that convergence and how we can leverage blockchain rails to make traditional finance more efficient. An example of that was this past weekend. We just did another set of on-chain U.S. Treasury repo transactions. And these were unique for a few different reasons. One, there was no intermediary risk on the Treasury, so it was DTCC that actually put them on top of a blockchain. All the transactions were atomic. So USDC and some other stablecoins were used as the cash legs. In this case, there was also rehypothecation. Because it was done on the Canton blockchain, privacy was preserved. So only the participants who needed to see the transactions saw the transactions. They weren't open to the whole world, which I think is very important. And it did, in addition to DTCC, Circle, and some other stablecoin providers, DRW, Virtu, Citadel, B of A, and SocGen all participated in these. So, that's an example of stuff that's happening now that's that we're involved with, that we're super excited about.
Great. I'm Rob Goldstein, BlackRock's Chief Operating Officer. Interestingly enough, in 2014, my contribution on this topic was being the person in BlackRock saying, I don't know if I believe in this, but it seems big enough that we should create a small group of people who do nothing but obsess about this to figure out the right moment. And broadly, I would say the strategy that we've been employing at BlackRock is a strategy about bridging. You basically have the traditional capital markets, and then you have this alternative universe, this digital asset universe that has been evolving and obviously has tremendous momentum. And what we've been doing as a company is trying to lead how you bridge the two together. So for example, the IBIT ETF, which has approximately $90 billion of assets, would be a great example where there's a tremendous demand among traditional capital markets investors to have access to these exposures, but to have access to these exposures in the same old way that they could have access to IBM stock, and it shows up on that same brokerage account that they're accustomed to getting. Another example would be going the other direction, where we actually manage one of the largest tokenized money market funds, BIDL, where it provides the ability to have access to a BlackRock money market fund, but to have it as a token that lives in this alternative universe. So when you look at that strategy, we believe very strongly that a lot of what's happening is this, Colleen, you had said the gradual merging of these two worlds, and we've been trying as a strategy to be that bridge to help bring them together in every way possible.
Cara Kennedy, I'm co-head of 𝐂𝐴𝐻. 𝐂𝐴𝐻 is JP Morgan's blockchain business unit. So we are in a unique position of sitting within, obviously, a significant bank like JP Morgan, but actively working to develop blockchain-based solutions for our clients. And we do that across assets, payments, and information, predominantly on networks that we operate today. And our focus is really on developing solutions, leveraging tokenization that will solve real-world problems for the bank's clients today, and help to develop those interoperability points between the legacy infrastructure that we clearly use for the vast majority of our business and the new opportunities that is afforded through the use of blockchain technology. So some examples of the products that we offer today, which leverage tokenization capabilities, would be our digital financing product, which is a product that our markets business operates, which enables the tokenization of collateral such as US Treasuries to be deployed in intraday repo transactions, which can be timed down to the minute, allowing repo sellers to much more precisely meet their liquidity requirements without having to have the kind of overnight exposures that would be required in the legacy infrastructure. So we enable tokenization of assets, traditional assets, onto our network. They can then be moved against our digital payment solutions. We operate 24/7, 365 blockchain-based payments infrastructure, enabling clients to leverage that. And then, as you may have seen this year, we also moved beyond into launching a proof of concept on deposit tokens, our JPMD product, which is initially launched on Base, and that really is looking to then meet what the need that we see next, which is to have a bank-grade digital cash product that can then be leveraged in the public blockchain ecosystem as well.
Thank you. Great. And the way that I've structured these questions, they're really open for everyone. So I don't plan on calling on any of you. So please just jump in. So the first one, when we think about tokenized money, so stablecoins backed by different reserve compositions, tokenized commercial bank deposits issued by banks with varying credit and regulatory profiles, maybe even eventually tokenized treasuries direct, how should we think about fungibility? And do you envision a future where we'll need to build new clearing mechanisms or special markets to price these assets?
I'm happy to jump in on that first. So, I think from our perspective, the products that you listed there, are very different products in and of themselves. And so I think we should recognize that there won't be fungibility between those different types, and maybe there shouldn't be fungibility between those different types. Tokenized deposits and stablecoins share a lot of characteristics, in terms of programmability and peer-to-peer transactions, but they also differ in very significant ways. A tokenized deposit has the quality of a bank deposit, and so largely, if structured correctly, should essentially be treated in the same way, and have the singleness of money that you have with any bank deposit that is held in a traditional form. And so we would see that those would be fungible ultimately, potentially across institutions, but with that stable value of a dollar that you see same as a bank deposit. But that is different than a stable coin. They're structured in a different way, and they are likely to be used in different use cases, perhaps different client segments that will leverage those products, and they will serve a purpose as well. So would expect to see those coexist. And then obviously when we get into more of the tokenized security products, whether that's treasuries or money market fund units or otherwise, again, those are meeting distinct needs, and just as in the traditional environment, should be considered different, distinct product types.
I'm just going to add a couple. We're just talking about a programming language, right? We have these conferences, and we're talking about it's a programming language, and it does some really cool things that make it better than some of the traditional rails. So that's great. But there's a lot of conversation about what should a stable coin, should they all be $1?
I want
Money market funds,
$1.50
way back when, had
stablecoin.
one break the buck, and it brought a rain of regulation down that have been really good things that control it, that it's pretty close to staying as $1.
Nickel stablecoins.
Well, why? If you think about what is risk-free, a risk-free investment is a US dollar, right? Everybody's kind of agreed that that's the best, safest
Yeah, but
investment you
staples
can
are
be.
not risk-free.
Anytime you add, just like in a chain, it's only as strong as its weakest link. You add other risk to it, it shouldn't be considered risk-free, and it will start to float away, of which the market will determine it in many ways, from the dollar. So what types of risk we have? Silicon Valley Bank was not a credit risk. It was a duration risk. So if suddenly you're holding a bunch of dollars and you've taken duration, you've just added a bunch of risk to that. The most recent fraud cases, Tricolor and First Trust or First Brand, or I can't remember whatever it's called, that's an operational risk, right? They resold the same loans that somebody should have checked in and made sure that the loans were tagged in a system. Good news is with blockchain, it actually probably reduces operational risk. Okay. So,
yeah.
When we talk about the stable coins, first of all, not all stable coins are made the same as far as what the collateral is behind them.
Okay.
That will
Maybe she does know
determine
what she's
a
talking
lot
about.
of what their capability is, depending on whether people apply a discount because they think that in that there's additional risk to it. So,
And if I could, it feels a bit
Wasn't
like
sure if the
Jeopardy
first
here.
half,
I'm sorry.
second half rolled
But
over.
if I could just echo, we couldn't agree more. This is just a technology. And I think where people often get confused, and one of the things that we get a lot of pitches at BlackRock from various ecosystem participants, what problem would fungibility actually solve? And is it a problem that's high on anyone's to-do list? And I think sometimes within this space, there's so much excitement that sometimes those steps are skipped. And I think importantly, going back to Jenny's comments about money market funds, there are differences between a bank deposit, a money market fund, cash, which is really a stable coin in its purest form is meant to be digital cash, and other types of investments, including short duration. So when you look at something like short duration treasuries, if you were in the traditional capital markets, it would never be fungible with cash at a price that's guaranteed. The price moves all the time. And I think that some of these concepts, there's a lot to learn, again, bridging the two universes.
So let's see, I will partially disagree. I think that
good, that makes a panel much more interesting.
Good, disagree.
I think that this statement that, hey, this is just a programming language misses what happens when you take a so-called real-world asset and you put it on chain. And there are different ways of doing that. And, if JP Morgan takes a JP Morgan deposit and puts it on chain, the character of that hasn't changed that much. It becomes a more useful instrument, but there's no incremental credit risk that's introduced into the system. Now, if let's say that there's a treasury security that's, that matures, I don't know, the next day or something. It's a one-day treasury. And let's say that some, I don't know, intermediary tokenizes that and puts it on chain. Well, that has different credit characteristics than the original treasury. And so that goes beyond just the programming language. There's additional risk that's introduced into the system because of the activity this intermediary took. Now, that's not the only way of getting it on chain. I mean, somebody could deposit that treasury at the DTCC, and DTCC could put it on chain, and I would argue now no incremental intermediary risk has been introduced. And so, the devil's in the details on.
Okay, I'm going to respond.
You can't
It's still a
interrupt them.
programming language. It just happens. It just happens to have the application of the programming that introduces those additional intermediaries. And if you think about what this programming language does really well, it does three things really well. It has one source of truth. Guess what? A huge amount of I know BlackRock, Franklin Templeton, JP Morgan, our operational costs, the number of people we have that reconcile data between systems is huge. Oh, and then we got to do a transaction, go reconcile it with the counterparty. Another expense. This completely eliminates the reconciliation, right? That's just the application of this programming. Like number two, it has the ability to execute smart contracts. We do a foreign exchange contract with somebody in Indonesia. We'd probably go to JP Morgan and say, could you please be our counterparty because we don't know who they are. Guess what? Atomic settlement, we don't need that anymore. Right, so it's just effective at how it executes on something that exists today. And third, it has a payment mechanism. And you can argue on the smart contracts how their value, the stable coins, the value, but it has a payment mechanism. Again, those are the applications of the programming language that create opportunity.
I find it weird
Yes,
that
they
they call it
create
a
tremendous
programming
opportunity.
language.
One of the questions that Colleen asked is, should there be some kind of a central mechanism to make sure that all these things are fungible? And my answer is no, absolutely not. These things are different. They have different characteristics, and it's important for the market to recognize that.
That's a good point. They are fungible.
And there are two different questions.
not.
One is, at what price do these things trade? And the other is, what is the appropriate haircut to apply to them if they are used as collateral? Those are two different questions. You could have a bunch of things that all are trading at $1 because the sun's shining and nothing's breaking. But a clearinghouse, and perhaps with the encouragement of the Fed and other regulators, could apply different haircuts to them to recognize the different types of risks inherent in these different items.
And
really
Don, I think
solid. I have something
in
to
what
say
you
when they're
just
done.
said, one very important component, and
It is, but it isn't.
again, I believe there's a lot to learn from traditional capital markets here. A lot of what people are calling tokens are wrapped in such a way that they're really more like a structured product. And fundamentally, I think we know through many decades that not fully understanding structured products is very dangerous. And I think that to create pure tokenized assets that don't have that structural component to it is going to require a catalyst. It may not be the only way of doing it, but it certainly, in my opinion, would be a catalyst and catalytic towards having some centralized, trusted intermediary who could help be the tokenization agent to take your asset from, I hate the term real world, but from the real world to this alternative universe. I hate the term real world because who wants to take something of value from the real world and put it anywhere else? But at the same time, I think there will have to be utilities that people trust that assist with that, at least in the early days, because these structured products that are being created are ultimately going to become a challenge.
I think I completely
cool.
agree with the points here about the absolute criticality of the structuring of these tokenized products. And in the applications that we have today, we have embedded the holding of the underlying position within a custodial framework, which clearly ensures that there is beneficial ownership of the underlying asset to whoever's holding the token at any given time. Now, obviously, that works within our applications for our clients when we're looking at this, perhaps on a wider ecosystem basis. Then it is important that we think through who that custodial entity is. And I was interested, Don, that you kind of identified that there is a clear risk difference of having a regulated clearing agency holding that underlying asset and being the tokenization agent versus, another providing that wrapper. And I think that is really important when we think about how the regulatory frameworks evolve, is ensuring that as far as possible, the token product needs to have the same legal rights and entitlements as the holder would have in the underlying traditional position. Obviously, if that's if it's a native issuance, if it's something that is that the issuer is putting on chain, that's much easier to achieve. But if there is an intermediary there, that needs to be in a framework which has the appropriate custodial responsibilities and the oversight to ensure that the holder of that token knows that they have all those legal entitlements that they would have in the underlying product. Otherwise, we definitely will be in a difficult position of having to navigate on a case-by-case basis what the kind of risk profile is and what the the legal terms and entitlements are, which is simply not something that's going to achieve that institutional adoption or scale.
Yeah, so I'm going to ask a question that I don't know the answer to. So Rob, if somebody buys BUIDL on chain, do they have the same rights as somebody who goes directly to BlackRock and invests in your money market funds?
It's structured that there's basically equivalence, yes.
Okay.
No,
as I said, I didn't know the answer. Yeah, I mean,
but part of the reason why I say is because, and this is where I think it again goes back to like technology and what problems are being solved, in that fundamentally, at some point, notwithstanding the success of the digital asset universe, people may want cash, or they may want cash at JP Morgan or something like that. And obviously, you need to go off-chain to do that. So you need to convert from a stable. The token is designed to be converted to stable coins. And then the stable coin, again, needs to be converted to dollars. So there's another hop. But in theory, it happens much faster than it would if you were buying a traditional money market fund.
So I'm just going to make one. Again, I say it's a programming language, but I love this programming language. I mean, it's very cool. It does some great things. The Franklin's money market fund is natively on chain. So what it can do, I mean, we literally calculate every second a yield, and we pay it every day in the account. So you actually see it. That's unlike our traditional money market fund where it was too expensive to do it. You needed $500 to open an account. Our on-chain money market fund, you only need $20 to open an account. And honestly, you're going to be able to trade it 24/7, 365, right? So that is what this is going to bring. And the cost differential, because you don't have all that reconciliation and everything, is dramatic and is important. And so when I say that a hedge fund who can own it for 4 hours, 32 minutes, and 22 seconds gets paid, that's a really cool thing. The question is, to Rob's point, I'm not seeing a bunch of them jumping in and saying we need that, but maybe they do. And what more importantly, what happens with technology is the first thing we all imagine is only to be more efficient at what you do today. This is going to enable some really interesting, cool, innovative, and a lot of stuff is happening there. So I don't want to dismiss those things because it will, and there needs to be an element of catch up, but it does some pretty amazing things. And just in our money market, I can see the difference of what this technology brings.
And Jenny, if I could just echo that, I think one thing that this panel may not have done the clearest job on, this is not even like the first inning in our opinion. Maybe it's the first. This hasn't started yet. So global equity market cap is $120 trillion, something like that.
Yes, perplexing. I'll get back to that.
Like if you really think about, this is still so early. So as we're talking about use cases, I would argue that many of the use cases with regard to tokenization today are either pilot-ish kind of projects, or they're production projects that in reality have been engineered to be in production, or they're very limited applications with certain like digital asset companies doing things with their treasury. There are very limited case studies today. This hasn't even started.
And yet, Bitcoin has had more transactions in 2024, I think, than Visa and MasterCard combined. So I mean, it's massive. Like
No.
First, I have the easiest job in the world because you guys just ask each other questions. So this is awesome, and I just get to sit and learn.
Maybe more value
So
transacted,
Rob,
not-
definitely we are early.
not more
Part of the reason I wanted to raise these questions, though, is it's also moving very fast. You know, we saw NASDAQ file to have tokenized public equities trade on the platform. They're working with DTC. They think this is going to be ready, you know, Q3 of 26. We see the CFTC has an initiative for tokenized collateral and stablecoin being used as good collateral on DCOs, DCMs. And that's why I wanted to raise these questions. Like, and then there is nuance within the products. You know, tokenized public equities, you can have derivatives effectively or issued natively on chain. And I think it's really important that we think about what is good collateral? Like, what do we want coming into our traditional markets? And how do we haircut that? Like, how do we think about those things? And one thing I wondered, I mean, given that we're here at the Fed, you know, with the Federal Reserve having joint oversight of our primary clearing agencies, ICE, CME, Options Clearing Corporation, you know, is there a role for the Federal Reserve to play in helping sort out, like, what kind of collateral comes back into our traditional markets?
Yeah, so I think absolutely. I think that this is a great opportunity for the Fed to lead on this, you know, to be a thought leader. And, you know, when it comes to, you know, just focusing a little bit more on stablecoins, you know, I don't think that it's a question, it should necessarily be a question of a binary question. It should be, what are the criteria for thinking about the haircuts? And I don't think the Fed should be the one determining
this man
the
does not
haircuts.
need
The
haircuts.
clearinghouses should, but the Fed can talk about the principles that should be used to determine the haircuts. And so, you know, I think that those should be, you know, what is the credit quality? And that's both the underlying assets and as well as any intermediary risk introduced in the wrapper. What is the liquidity profile of those underlying instruments? And you know, what is their convertibility or the ability to transform them into cash almost instantaneously? And then what is the transparency? And this is an opportunity for, you know, stablecoin issuers and money market funds to compete. Eventually, I envision a world where all of the assets, whether it's a stablecoin issuer or a money market fund, that all of their underlying assets are on chain. And we shouldn't have to wait for the monthly audit to see where the stablecoin reserves are invested. We should be able to see in real time where those are. And that, you know, hopefully we see competition towards that transparency. And then, you know, you can look at it and you can say, okay, well, you know, this stablecoin issuer decided to put their reserves primarily at in bank deposits. Okay, that's probably less safe than a different stablecoin issuer that has it all in very short-dated treasuries. And you know, there can be a discussion about what the haircut implications are for that. They're probably all going to trade $1, but the haircut implications are going to be very different.
So, Don, I agree with that. I think we're quite some time away from that. I agree with that. I also think we need to take a step back. I think there's a tremendous role for the Fed to play. I think it has to start with education. So as a starting point, you know, some of us, I know Jenny's definitely in this camp, we spend a tremendous amount of time traveling the world and meeting with asset owners all over the world. And many of them are among the most sophisticated asset owners on the globe in the capital markets. Not only do they not understand a lot of what we're talking about, but to them, it has to actually solve a problem. So if you're going to start having a little bit of the portfolio over here on this sort of alternate universe, but everything else is over here at JP Morgan, that actually doesn't solve a problem, it creates a problem. So there has to be a value proposition, and I think there are still a fair number of people who need to be educated and just some fundamental frictions that need to be resolved to make it easy for asset owners to continue to see their whole portfolio. And I think a lot of times we have these discussions and it becomes very binary between like everything's on chain or everything's not. we're going to have to be building technologies and building an ecosystem that is thinking of a hybrid solution, because that's the realistic outcome for many decades.
Yeah, I think that's a really valid point around the readiness for adoption and what that really means, because I think, you know, we've talked about some of the transformational potential of this from an asset perspective, but also that means moving away from, you know, daily cycles for funding settlement, or, you know, would mean differences in terms of
World.
Well, that leads me perfectly into the next question in terms of 24/7, 365 trading in the crypto markets. So far we've focused on crypto assets moving into our traditional markets, but I think we also need to spend some time on the reverse. So as traditional assets like public equities and commodities are tokenized and traded and used as collateral in DeFi, what are some of the issues we should be thinking about? So some of the things I think about: fragmentation of liquidity on-chain and off-chain. Are there challenges to using oracles to price tokenized assets accurately? Do we need some form of circuit breakers in DeFi? I'm not sure how we would do that, but it's a question. How do we ensure, and Don, I'll definitely start with you, but how do we ensure that centralized and decentralized exchanges don't shut down and not accept deposits during times of market stress? And should we rethink how auto-deleveraging systems work in DeFi? And the reason I'm going to start with Don is he published a great piece last week called "If DeFi is the Future of TradFi, What Did Friday Teach Us?" And that's referring to October 10th, where we saw about 19 billion in liquidations across the crypto markets. So I'm wondering, you know, what are some solutions here? Don, this one I will pick on you to start, and then would love for everyone else to join.
Yeah, so, you know, I was so perturbed by what happened and some of the failures that we saw in the market that I decided to send out my first ever thread on X. So I don't know, maybe it will all go downhill from here, but and so some of the points that I made, I highlighted some things that happened on October 10th that I think that a lot of people in traditional finance aren't aware of, that these things happen. And you know, when you go to 24/7 trading, then you need to go to real-time collateral management, and it brings all sorts of challenges with it. And you know, that the time that this kind of flash crash happened was a late Friday afternoon Central Time. Probably one of the most illiquid points of the day, and also a time when a lot of people's systems are kind of, you know, take a break. And so some of the things that we saw were oracles became unreliable. So, you know, an oracle is the mechanism that's used to record the price that you're using to measure whether somebody has sufficient collateral or not. Obviously, that's a really critical thing. And so, you know, I think it highlighted the importance of having really robust oracles. You know, I think that oracles should be properly regulated. The other thing that happened was, you know, some of the crypto platforms actually provided liquidity for the liquidations themselves. And this is kind of one of these practices that I think is just a horrible practice where, you know, an exchange has their own market maker on it. You know, it just creates all sorts of conflicts of interest. True. Definitely not best practice, but especially then when that liquidity provider is actually the, you know, kind of steps in to take the final bit of the liquidated order. And you can see it on chain on some of the platforms where, you know, the first clip of liquidation was sold into the order book, the next clip was sold into the order book, and the final clip was internalized and then sold back into the market half an hour later for a big profit. And you couple that with the observation that some of the wallets were closed. In other words, people were unable to top up their wallets, presumably because there was so much activity. But you kind of ask the question of like, well, did that benefit the exchange, or did that benefit the platform? Did they make more money in the liquidation because people weren't able to top up their collateral? And all of a sudden you know, it just doesn't look good. I'm not at all suggesting that that's the case, but it just highlights the problems with these conflicts of interest. And so that is definitely not what we want to replicate. And that was kind of the point that I was making.
Look, the things that happened on that day are things that have happened in traditional finance in history. And it just takes time for the system. You know, like Binance's pricing system worked until it didn't work because they had one source of pricing, and it was, you know, probably one that anybody who really looked at it would have said, that's probably not going to work in times of stress. I mean, these things happen, right? This stuff will all evolve as they get identified. In traditional asset management, everybody talks about private markets and the growth of private markets, and we need to democratize them. And blockchain is going to be the great way as we tokenize private markets. And I always say, this exists, this potential exists today, but you don't get liquidity unless you have market makers who exist there to create liquidity, which means you have to have an inventory, which means you have to have a system that's in place. All these things evolve. I think it will inevitably, we will go to 24/7. By the way, if you have a Schwab account, you can trade 24/7. And I think less than 4% of their trades actually happen after hours. So it can happen. This is definitely going to be a more efficient way to do it. It's going to be cheaper to do it. And you need to have the arbitrage between markets. You know, I think Franklin stock is, you know, New York Stock Exchange and the London Stock Exchange. Guess what? There's people who arbitrage pricing so that you ensure that it stays very narrow. And that infrastructure, the maturity of it, hasn't been built today yet. I mean, it's happening. And as it happens, I genuinely believe it ultimately replaces the current rails in the system. It takes a little time to do it. But we also shouldn't forget that there are a lot of big companies that are toll takers on the current system and are actually incented for this not to happen very quickly. And so that's going to slow it down too. But again, I think the capabilities and the evolution of the market, these kind of days that happen, wake people up to issues that you then go and fix.
But it's interesting because, and maybe this goes back to the point earlier, the question earlier about the role of the Fed. I think importantly, if you had this kind of issue in the public markets and it was about some arbitrage or some... but you have had it. It leads to someone looking at it and actually knowing that tomorrow will be better than yesterday in terms of having supervision of infrastructure, certain standards, market quality, just a variety of things that I think for the capital markets to have widespread adoption here, we have a gap between where we are today and where it ultimately needs to be.
Yeah, the challenge is this infrastructure is going to make it a heck of a lot easier to move money across boundaries. And there's no global regulation around it, so you're still going to have this mismatch that honestly you have a little bit today, but a lot of people follow the Fed, so you end up in big developed markets having a little bit more standardization.
Right, but even something, Jenny, going back to your point about whatever exchange, importantly, if you think about the number of people who must do reviews of just the basic technology governance of the New York Stock Exchange, I don't know what the number is, but I'm assuming there's a lot of people who do a variety of like technical due diligence on them as part of their regulatory regime. There are certain basic things you could do if you want to transact here.
Agreed, but again, you know, I mentioned the two frauds that we see. I mean, I used to do securitizations, and like I'm still trying to figure out how you sell the same loans. You know, like like somebody's got to go in and change the system. Usually, you tag them, so it happens even in traditional. I think it's harder. I think it will be harder to do with this technology going forward. I think that's the good news about this technology, but the development in the infrastructure doesn't quite exist.
They love stablecoins.
I think I completely agree with you, Jenny, that this will this will evolve,
They don't
right?
love
And
Bit-
this
they love
and the
Bitcoin.
events
They love
of
stablecoins.
Friday was really, that is something that is going to focus a lot of minds, both in the crypto space, but it is also going to be an education for any risk managers within any of the institutions that are looking to get into this. There'll be a lot of a lens on that. I think, Colleen, you asked the question about, thinking about that in the context of potentially, public equities and securities going into this environment. And I think that is really the key takeaway for me is to think about how careful we have to be about deploying, securities into these sorts of ecosystems where perhaps those risks are not fully understood or assessed at this point. And so ensuring we have the appropriate guardrails in place, ensuring that, if there are actors who are operating, whether that's, kind of activity that would otherwise be regulated in the traditional world as broker-dealer activity or exchange activity, that there is, that they are required to meet the same standards and regulations as exists in the traditional space, because it's, the capital markets and protecting, investors and confidence is paramount. And we know enough from the experiences of the traditional world that we don't need to make those mistakes in terms of the experimenting in this space. We need to make sure we go in with the right approach from the start.
So I just saw the unfortunate news that we're down to like 13 minutes. I was worried we didn't, that we had not enough questions and we're only through 3 of them. But let me switch to audience questions really quick. So Representative Foster from Illinois, great, 2 Chicago people here. It seems that most of the new initiatives we've heard about today use permission distributed ledgers. And Representative Foster is asking if that's a trend.
Yeah, so the Canton Ledger has, I guess, configurable permissioning, if you will. It has configurable privacy and also configurable permissioning. And so that's a nice hybrid environment that enables regulated entities to configure whatever levels of permissioning they need to operate in a regulatorily compliant manner. So we think that that's kind of the best of both worlds. Yeah.
I was just going to say, look, I had this debate with somebody who today in the room is doing something on the permissionless side. And I said, look, we're a regulated entity across the globe. Our tokenized money market funds better not end up in a wallet that isn't been approved on the whitelist and is AML KYC'd. We're going to be in trouble. So I don't know how you do that without, having a certain, whether it's programmed in the token to ensure that the wallet's clean. I just think that that's a reality.
Yeah, I mean, I was going to say the same thing. It's a reality of operating in the regulated space. It's something that there's different tools, obviously, for permissioning. I think there's been an evolution, perhaps, from private permission chains to looking at how you can enact permissioned environments within the public domain. But the AML KYC requirements that we're rightly subject to, that's a non-negotiable, particularly for institutional players. And so having the ability to control that either through whitelists or hopefully in time through more, perhaps more on-chain technology solutions enabling that, I think that is going to be, it's a critical part of how we operate our businesses today.
And not only there's no disagreement, but I would almost take a step further. This is a luxurious point in time in that, going back to the initial point of this as a technology and this being nascent in the relative scheme of things, it's a unique time where you could build with no legacy in a way that should have a more rigorous AML KYC framework, because it's not about having people take a picture of their driver's license and fax it to you. So I think so much of the narrative is on what could go wrong, as opposed to the principles of how do you build something new that is actually both more efficient and more controlled for the most important elements relative to what we have today.
Did you say facts and crypto in the same conference? Wow.
Well, because we're running out of time, I do want to talk about what can go right. So I would love to hear where each of you think the tokenization space in particular will be over the next 5 years. Jenny?
You know, technology adoption is always slower. What was the saying? It's much slower. What is it? Yeah, but it's like, you know, the first 2 years, I can't really give a term, it's much, much slower, and then it just takes off, and you can't imagine 10 years. That's what's going to happen here. Like, this is going to be one, first of all, going to these digital asset or crypto conference, I am stunned by the number of people who attend, the enthusiasm and the creativity that happens in these places. And I am also stunned to go in on the traditional side and how much they ignore it and say, another crypto winter, not gonna happen again, we don't need to pay attention to it. And at some point, you know, this, whether you call it a bridge or whatever, you have these pools of projects that are going on. You know, central banks have been working for a couple years in Asia and Europe on kind of being able to move their currencies on blockchain. And what's going to happen is these things are going to start to connect over time, and people are going to turn around and say, how did that happen so fast? And anybody who's been living in the ecosystem is going to say, are you kidding me? It's taken so much time. So, you know, is it 5 years that we see the hockey stick? I think so. I can tell you that I have more conversations about this where people are now inbound asking about it as opposed to us saying, and by the way, I want to mention one other thing.
Yeah, so I have to preface this by saying that I'm usually wrong. You know, I lived in London in the mid-90s, and I watched the Bund futures pit completely disappear and be taken over by the DTB, which was, you know, now Deutsche Börse, the electronic platform. And then I moved back to Chicago in 96, and I was, you know, on the trading floor at the Merck, and I said, you know, if this place is not completely electronic by the year 2000, they're going to be out of business. And I was so wrong. Of course, eventually they became electronic. So I was right in the long term, just my timing was wrong. So with that preface, you know, my expectation is that in five years from now, that every instrument that is traded frequently will be traded on-chain. That is my prediction.
And I'll take it a step further. I think that a lot of this stuff is not an if, it's a when. It's hard to predict if it's 2030 or 2032 or 2027. But I think it's quite clear that if there are $4.5 trillion in digital wallets today, that number is going up, not down, and that wealth accumulation is going to have the ability to create the whole portfolio in that digital wallet. They'll have access to traditional capital markets instruments like stocks and bonds, and they'll have access to funds that companies like Franklin and BlackRock create. They'll have access to ETFs. They'll have access to model portfolios that will be on chain, hit a button, automatically happens and automatically rebalances. I believe these things are a question of when, not if. Someone had asked me the question, I wish I knew how to answer it. They said, with all of the wealth that's being created in AI, when you look, a lot of the fundraising that's been happening, a lot of it's been primary capital, but a lot of it's provided liquidity to employees. And they said, what % of that liquidity do you think is going into a Schwab account relative to going into a wallet? And I don't know what the answer is, but I think we all know some material component of that wealth creation is going into wallets. So it's just going to grow and grow and grow. And this will be another way for the capital markets to grow also.
Yeah, I think getting the timing estimates right here is always going to be very difficult. But I think, you know, just look at how far we've come in a year. You know, we're in a very different position now. And I think we'll continue to see that acceleration, particularly in the regulatory environment. To some extent that was already advanced globally, and then obviously that has moved at pace in the US this year. I think next year we'll see significant advancement in terms of commercial bank money on chain. So, the cash side has really matured and will continue to do so, and see that as a significant area, in the shorter term. And then I think we will take the next step in that evolution towards some of the things we've talked about today in terms of structuring around more of the securities and assets side, which will build, so in 5 years, I think we'll have much clearer building blocks for sure that can then start to develop some of those, model portfolios and the kind of programmable investment vehicles, which is really where it starts to get very interesting.
Great. Ria, should we wrap up, or do we have 4 minutes? Okay, great. So final question, and we've touched on this a little bit, but given that we're here at the Federal Reserve, what do you think the Federal Reserve could be doing to help tokenization grow? I'll close with that.
Yeah, I mean, one thing I think the Federal Reserve could do is take the lead in putting together a cross-agency task force to help. I mean, because obviously this cuts across CFTC, SEC, OCC, to help think about tokenized collateral and best practices, et cetera. I think that would go a long way.
Transparency and clarity of regulatory environment is always what's so important for the market, right? People want to understand what the rules are of the road, and then they can build within that. And to the extent that and consistency across regulatory agencies, to the extent that there isn't clarity around that, that makes people fear innovation.
I think just to add to that, probably the kind of level playing field piece is important. So thinking about ensuring that we have the ability for regulated institutions and non-regulated institutions to participate on the same terms is critical.
And I would just echo that. I think that having more participation and more, I would say, embraced participation of highly regulated organizations, particularly banks, is going to be a dramatic catalyst towards unlocking innovation here. And I think the more that they're constrained or sort of on the sidelines, the harder it is for this to really get scale.
Yeah, I'll mention 2 more things. One is, thinking about, longer real-time gross settlement windows. And intraday liquidity for on-chain settlements, just kind of
Those are a lot of
rules
words.
around that. And the other thing is, there are now rules that at some point in time in the future, repo is required to be cleared. And I think those rules were written in a time before on-chain activity was really taken seriously. And so I think it's important for the regulators to go back, take a look at those things, and make sure that they're not doing anything to actually hamper on-chain repo transactions.
Great. And with that, I'd like to thank Kara,
Great.
Rob.
I'd like to thank everybody who tuned in today. This actually was pretty cool, better than I expected. Usually they're extremely dry, and it was, but there were some good things in between. Biggest disappointments, I hate that they always talk about stables. They don't ever talk about Bitcoin. They never talk about really anything other than stable coins. They clearly have a hard on for stables. And let's take it for what it is. It's still a blessing that if they're interested in it, we're going to see acceptance and innovation and more involvement in the whole space overall. I love how I went to the bathroom. My trade just got completely wrecked. This might be wrecked, but this is cool. I appreciate everyone tuning in. We have 𝐿 joining us on the 29th on Wednesday, the last Wednesday of the month. So you better be here for that. It's going to be big. It's going to be very big. I don't even remember. My energy, my attention is just drained throughout this whole thing. I do appreciate everyone tuning in. Make sure you've liked and subscribed. Tune back in for our next live tomorrow, I assume. Jump to the Discord, discord.gg/TomCrown. Sign up with our exchange partner, BYDFi. Links in the top of the chat, in the description. It's everywhere. You'll get some big bonuses. You'll get VIP roles in our Discord just for signing up using my link. You'll get everything. You get it all. Anyway, I'll catch you guys soon. I appreciate you. Crown out.